Section 4, Due Diligence and Manager Selection, Hedge Funds, Strategies and Techniques for Advanced Investing. 4.1 Hedge Fund Due Diligence. When considering an investment in a hedge fund, conducting thorough background checks on the hedge fund manager is essential to evaluate their credibility, track record, and potential risks. Here are some steps to conduct a comprehensive background check on hedge fund managers. Regulatory check. Verify the hedge fund manager's registration and compliance with relevant regulatory bodies, such as the Securities and Exchange Commission, SEC, in the United States or the Financial Conduct Authority, FCA, in the United Kingdom. Check for any disciplinary actions, complaints, or enforcement actions taken against the manager by regulatory authorities. Track record and performance analysis. Assess the manager's track record and performance history, including their returns, risk management practices, and consistency of performance. Review the manager's audited financial statements, if available, to gain insights into their financial stability and resources. Due Diligence Questionnaire, DDQ. Prepare a comprehensive due diligence questionnaire to gather detailed information about the manager's background, investment strategy, risk management processes, operational infrastructure, and compliance policies. Request information about the manager's experience, qualifications, key personnel, and their roles within the organization. Obtain details on the fund's assets under management, AUM, fund structure, fee structure, and any potential conflicts of interest. Background and reference checks. Conduct background checks on key individuals within the management team, including the fund manager, investment team members, and senior executives. Verify their educational background, professional qualifications, and previous work experience. Seek references from industry professionals, clients, or other investors who have had direct experience with the manager or their fund. Legal and litigation history. Check for any legal or litigation history involving the manager or their firm, including lawsuits, regulatory investigations, or settlement agreements. Research any potential legal or reputational risks associated with the manager, such as involvement in fraudulent activities or misconduct. Operational due diligence. Assess the manager's operational infrastructure, including risk management systems, trading processes, valuation practices, compliance procedures, and cybersecurity measures. Evaluate the fund's service providers, such as prime brokers, auditors, and administrators, to ensure they are reputable and independent. Third-party due diligence providers. Consider engaging third-party due diligence providers or consultants specializing in hedge fund analysis to conduct a more extensive assessment of the manager's background, operational capabilities, and risk management processes. Remember, thorough background checks are crucial, but they should be complemented with a holistic evaluation of other factors, including the investment strategy, fund terms, fee structure, investor terms, and overall fit with your investment objectives and risk tolerance. It's recommended to seek professional advice from legal, financial, or investment professionals who can assist in conducting the due diligence process effectively. Assessing investment strategies, track records, and risk management processes are critical steps in evaluating hedge fund managers. Here are key considerations for each aspect. Investment strategies. Understand the investment strategy employed by the hedge fund manager. Evaluate its clarity, consistency, and alignment with your investment objectives and risk tolerance. Assess the manager's expertise and experience in implementing the strategy, as well as their ability to adapt to changing market conditions. Consider the uniqueness of the strategy and whether it provides a differentiated approach or edge in the market. Track records. Review the manager's historical performance track record. Analyze returns, risk metrics, and consistency of performance over different market cycles. Evaluate performance against relevant benchmarks or peers to determine if the manager has generated consistent and competitive returns. Assess the attribution analysis of past performance to understand the drivers of returns, such as asset allocation, security selection, or market timing. Risk management processes. Evaluate the hedge fund manager's risk management practices, including their approach to identifying, assessing, and mitigating risks. Understand the manager's risk appetite, risk tolerance, and risk limits. Assess if they align with your risk preferences. Review the manager's risk measurement tools, stress testing procedures, and scenario analysis to ensure they have robust risk controls in place. Assess the manager's ability to adapt to changing market conditions and their risk management response during periods of market stress. Compliance and operational risk. Evaluate the manager's compliance policies and procedures to ensure they meet regulatory requirements. Assess the effectiveness of the manager's operational infrastructure, including trade execution, settlement processes, valuation practices, and cybersecurity measures. Consider the manager's transparency and reporting practices, as well as their willingness to provide timely and accurate information to investors. Team and expertise. Evaluate the expertise and experience of the hedge fund manager and the investment team. Assess their qualifications, education, industry reputation, and stability. Consider the team's ability to generate investment ideas. Conduct thorough research, and execute the investment strategy effectively. Assess the stability and depth of the team, as well as their succession planning to ensure continuity in managing the fund. Communication and transparency. Evaluate the manager's communication practices and transparency. Assess their willingness to provide regular updates, reports, and timely responses to investor inquiries. Look for a clear and transparent fee structure, as well as disclosure of any potential conflicts of interest. Remember, assessing investment strategies, track records, and risk management processes requires a combination of quantitative and qualitative analysis. It is important to conduct thorough due diligence. Review relevant documentation, and consider seeking advice from professionals with expertise in hedge fund analysis or investment management. Legal and operational due diligence are essential components of the due diligence process when evaluating hedge fund managers. These assessments help investors understand the legal and operational aspects of the fund, ensuring compliance with regulations and evaluating the robustness of its operational infrastructure. Here are some key considerations for legal and operational due diligence. Legal due diligence, fund structure and documentation. Review the fund's legal structure, such as a limited partnership, limited liability company, or offshore vehicle. Understand the rights, responsibilities, and obligations of the fund's participants. Examine the fund's governing documents, including the partnership agreement or operating agreement, to understand the fund's objectives, investment strategy, redemption terms, fee structure, and distribution policies. Regulatory compliance. Verify the manager's registration and compliance with relevant regulatory authorities, such as the Securities and Exchange Commission, SEC, in the United States or the Financial Conduct Authority, FCA, in the United Kingdom. Ensure the manager adheres to applicable securities laws, anti-money laundering, AML, regulations, and other regulatory requirements. Disciplinary history. Conduct background checks on the manager and key individuals within the organization to identify any history of regulatory or legal violations, disciplinary actions, or lawsuits. Verify the manager's compliance record with regulatory authorities and check for any enforcement actions or settlements. Conflicts of interest. Assess the manager's policies and procedures for managing conflicts of interest, such as personal trading, allocation of investment opportunities, or side letter arrangements with specific investors. Evaluate the manager's disclosure practices regarding potential conflicts of interest and assess their transparency in addressing such conflicts. Operational due diligence, risk management framework. Evaluate the fund's risk management processes, including risk identification, measurement, monitoring, and mitigation practices. Assess the effectiveness of the fund's risk management framework, including the use of risk limits, stress testing, scenario analysis, and portfolio diversification strategies. Operational infrastructure. Evaluate the fund's operational infrastructure, including trade execution, settlement processes, fund administration, and valuation practices. Assess the reliability and independence of key service providers, such as prime brokers, custodians, auditors, and administrators. Business continuity and disaster recovery. Review the fund's business continuity and disaster recovery plans to ensure they have robust measures in place to mitigate operational disruptions. Assess the fund's cybersecurity practices, data protection policies, and IT infrastructure to safeguard sensitive information. Compliance and internal controls. Evaluate the fund's compliance policies and procedures to ensure they meet regulatory requirements. Assess the effectiveness of internal controls, such as trade reconciliation, trade confirmation, and trade settlement processes. Review the fund's policies and procedures related to anti-money laundering, AML, and Know Your Customer, KYC, requirements. Service provider due diligence. Evaluate the qualifications, reputation, and stability of the fund service providers, such as prime brokers, auditors, administrators, and legal counsel. Assess the fund's relationships with these service providers to ensure they are independent and free from conflicts of interest. During legal and operational due diligence, it is recommended to engage legal counsel, operational due diligence specialists, or third-party consultants with expertise in hedge fund analysis. They can assist in conducting a thorough assessment of the fund's legal and operational framework, identifying potential risks, and providing insights into industry best practices. 4.2 Manager selection and allocation. Developing an investment thesis and strategy allocation is a critical step in constructing a hedge fund investment portfolio. Here's an overview of the process. Investment thesis: identify the core beliefs and assumptions that form the basis of your investment strategy. This includes understanding macroeconomic trends, market conditions, and potential opportunities or risks. Conduct thorough research and analysis to support your investment thesis. This may involve studying economic indicators, industry trends, company fundamentals, and market dynamics. Define the investment objectives, time horizon, risk tolerance, and return expectations that align with your investment thesis. Asset allocation: determine the appropriate allocation across different asset classes, such as equities, fixed income, currencies, commodities, and alternative investments, based on your investment thesis and risk-return objectives. Consider diversification across asset classes to reduce portfolio risk and enhance potential returns. Assess the expected returns, risks, and correlations of each asset class to optimize the portfolio's risk-return profile. Determine the target allocation for each asset class based on your investment thesis and risk management considerations. Strategy allocation: select specific investment strategies that align with your investment thesis and asset allocation framework. Evaluate different hedge fund strategies, such as long/short equity, global macro, event-driven, relative value, or quantitative strategies, based on their potential to generate returns in line with your investment objectives. Assess the risk-return characteristics, historical performance, and track record of each strategy to ensure they fit within your risk tolerance and expectations. Allocate capital to each strategy based on their expected returns, risks, and correlation with other strategies in the portfolio. Consider the capacity constraints of each strategy to ensure effective execution and scalability. Risk management: develop a risk management framework that aligns with your investment thesis and strategy allocation. Identify and assess the various types of risks associated with each strategy and asset class, such as market risk, liquidity risk, credit risk, and operational risk. Implement risk management techniques, including diversification, position sizing, stop-loss orders, and portfolio rebalancing, to control and mitigate risks. Monitor and review the portfolio's risk exposure regularly to ensure it remains within predefined risk limits and adjust the allocation if necessary. Monitoring and rebalancing: regularly monitor the performance of the portfolio and individual strategies against their respective benchmarks and targets. Review the investment thesis and market conditions periodically to assess if any adjustments or changes to the allocation are warranted. Rebalance the portfolio by adjusting the allocation across strategies and asset classes to maintain the desired risk-return profile and respond to changing market dynamics. It's important to note that developing an investment thesis and strategy allocation requires a combination of research, analysis, experience, and judgment. Consider consulting with investment professionals, conducting thorough due diligence on investment strategies and managers, and regularly reviewing the portfolio's performance and risk exposure to make informed decisions. Evaluating performance consistency and risk-adjusted returns is crucial to assess the quality of a hedge fund's performance over time. Here are some key considerations when evaluating these aspects. Performance consistency: review the hedge fund's historical performance over multiple time periods, including different market cycles and economic conditions. Assess the consistency of returns by analyzing the fund's performance quartiles, standard deviation, and rolling returns. Look for stable and consistent performance that demonstrates the fund's ability to generate returns over the long term. Risk-adjusted returns: use risk-adjusted measures, such as the Sharpe ratio, Sortino ratio, or information ratio, to evaluate the fund's performance in relation to its level of risk. The Sharpe ratio measures the excess return earned per unit of risk, usually volatility, and helps assess the fund's risk-adjusted performance. The Sortino ratio is similar to the Sharpe ratio but focuses on downside risk, specifically measuring the excess return earned per unit of downside deviation. The information ratio measures the excess return earned per unit of active risk, comparing the fund's performance to a benchmark. Benchmark comparison. Compare the hedge fund's performance against relevant benchmarks or peer groups to evaluate its relative performance. Choose benchmarks that align with the fund's investment strategy. And asset class exposure. Evaluate the fund's ability to outperform benchmarks consistently and by a significant margin. Consistency of investment process. Assess the consistency of the fund's investment process and methodology over time. Look for evidence of disciplined and systematic investment decision-making processes, risk management practices, and adherence to the stated investment strategy. Evaluate if the fund has deviated from its stated strategy or made significant changes in its approach, as this can affect performance consistency. Drawdown analysis. Analyze the fund's drawdowns, which represent the peak-to-trough decline in value during a specific period. Assess the severity and duration of drawdowns, as well as the fund's ability to recover from them. Look for strategies and managers that have demonstrated an ability to manage drawdowns and recover from losses effectively. Peer group analysis and ranking. Compare the fund's performance and risk-adjusted returns to its peer group or similar funds in the industry. Evaluate where the fund ranks within its peer group, considering factors such as performance quartiles or percentile rankings. Track record length. Consider the length of the fund's track record and evaluate performance consistency over different market cycles. Longer track records provide more data points for analysis and help assess the fund's ability to navigate various market environments. It's important to note that evaluating performance consistency and risk-adjusted returns should be done in conjunction with other factors, such as the fund's investment strategy, risk management processes, and the alignment of its performance with your investment objectives and risk tolerance. Consider seeking advice from investment professionals or consultants with expertise in hedge fund analysis to assist in evaluating performance and risk-adjusted metrics effectively. Negotiating terms and fees with hedge fund managers is a common practice in the hedge fund industry. While each negotiation is unique, here are some key considerations and strategies to keep in mind. Understand the fee structure. Familiarize yourself with the typical fee structures used by hedge funds, such as management fees and performance fees, also known as incentive fees. Management fees are usually charged as a percentage of assets under management, AUM, and cover the fund's operating expenses. Performance fees are typically calculated as a percentage of the fund's profits above a certain hurdle rate or high water mark. Understand any additional fees or expenses that may be charged, such as administration fees, custody fees, or fund-level expenses. Research comparable funds. Conduct research to understand the industry standard for fees and terms applicable to funds with similar strategies. Track records and assets under management. Benchmark the fees being offered by the fund you are negotiating with against comparable funds to ensure they are reasonable and competitive. Assess the fund's value proposition. Evaluate the fund's investment strategy, track record, risk management processes, and the expertise of the investment team. Consider the unique aspects of the fund, such as its performance, specialized investment approach, or access to exclusive investment opportunities. Assess the fund's ability to generate alpha, excess returns, and whether it justifies the fees being charged. Consider your investment size and duration. Larger investments or longer-term commitments may provide leverage when negotiating terms and fees. Hedge fund managers may be more willing to negotiate fees for substantial investments or longer lockup periods. Negotiate fee structure. Discuss potential adjustments to the fee structure, such as lower management fees, performance fee breakpoints, or a reduced high water mark. Explore the possibility of fee reductions or fee waivers based on certain performance milestones or investor-friendly terms. Seek customization. Consider negotiating customized terms that align with your specific requirements, such as customized reporting, additional transparency, or tailored risk management. Focus on the long-term partnership. Emphasize the importance of a long-term partnership and express your commitment to supporting the fund's success. Highlight your expertise, network, or resources that may add value beyond just capital investment. Use competing offers or alternatives. If possible, explore other investment opportunities or funds with comparable strategies to create leverage in the negotiation. Having alternative investment options can provide you with negotiating power when discussing terms and fees. Seek professional advice. Engage legal counsel or financial advisors with expertise in hedge fund negotiations to help guide you through the negotiation process and ensure your interests are protected. Remember, negotiating terms and fees with hedge fund managers is a collaborative process. It's essential to approach the negotiation with a clear understanding of your objectives, a realistic assessment of the fund's value proposition, and a willingness to find mutually beneficial terms that align the interests of both parties.